interest rates could begin to rise in a matter of months after high inflation in the December quarter exceeded expectations. The Reserve Bank has been forced to rethink its economic stimulus after the consumer price index rose by 1.3% in December, and consumer price growth for the year rose to 3.5% in 2021. That's up from 3% in September. Now, a lot of people may well be confused about what all of this means. Well, let's bring in the chief economist at the AMP Capital, Shane Oliver, to get his thoughts on what's going on. There's plenty going on in this space. Shane, good morning to you. So first of all, are you expecting, and if so, how many, rate rises this year?
We certainly are. In fact, we have been for a while now. Only last week, with the unemployment rate falling to 4.2%, we brought forward our expectation from November to August. And yesterday's numbers imply that there is a risk that it could come even earlier. But basically, we're looking for two hikes this year. The first one in August, taking the cash rate to 0.25%, only a modest move because it's currently 0.1%, and then another hike in September, taking it to 0.5%. But as I said, yesterday's inflation numbers certainly surprised on the upside, so it could come a little bit earlier. I don't think the Reserve Bank's going to rush into it next week when they have their first meeting for the year, simply because they'll probably be a little bit inclined to wait and see whether it's some of the factors driving inflation are temporary and whether they subside or not. But I think the reality is that inflationary pressures are much stronger than the Reserve Bank expected, and we've got a much tighter labour market, and those things point to imminent rate hikes this year.
Okay, so for everyone out there watching, people are going to be concerned about how much more they're going to be spending. What does this mean for people with big mortgages, Shane?
Well, it means they're going to be paying more to cover the interest costs on those mortgages. So don't forget, we've already started to see fixed mortgage rates rise. That doesn't affect the borrower who was already locked in for 2 years or 3 years, but used to be able to get interest rates on fixed rate mortgages, down below 2% just 6-8 months ago. Now that's getting a lot harder. So they've already been going up, and that's one reason why there's a bit of a dampening coming through in parts of the property market around Australia, because 50% of borrowers have been taking out fixed rate mortgages. Now, of course, when people roll those loans over in 2 or 3 years' time, when the term expires, they've got to refinance, then they're going to find much higher interest rates on their loan. But the real impact this year will come for those, and that's most Australians with a mortgage, who are still on variable rate mortgages. They've been at ultra low levels, depending on your bank. Now, somewhere in the threes generally. Sometimes it might be high twos, but that's going to start going up, I think, from whenever the Reserve Bank starts raising interest rates. If they start moving in August, then you're going to start to see those interest rates go up. And that's going to mean that Australians are going to have to pay more to service their mortgage. Now, bear in mind, interest rates are still going to be at very, very low level. Even if the cash rate goes up to 0.5% this year, that's still a pretty low level. But Australians will face that increase in the cost of servicing their loans, just as right now we're seeing an increase in the cost of living more broadly, as highlighted by the CPI result.
Okay, so let's try and find a silver lining here. I mean, Joe Biden got himself into a pickle yesterday when he was asked about inflation, and the mention was that higher inflation can be good. Some people even suggest that it may well lead to pay rises. Is that something that you would agree with? Will this accelerate wage growth?
It will, and that is the silver lining on the cloud here. With inflation, if you look back over the last few decades, there's a sweet spot. You really want inflation to be somewhere between 2 to 3%. When it's down in the ones, it means very, very low wages growth, and you can always tip over into deflation. And we don't really want deflation. That's what they've had in Japan for many years. And with wages falling, it can mean people struggle to make their mortgage payments. So you don't want ultra low inflation. By the same token, as we saw in the 70s and 80s, we don't want ultra high inflation. Because that leads to financial instability, too much speculation, volatile economic cycles. So you really want this sweet spot, and that, of course, is what we're hopefully heading back towards. Sounds a bit higher at the moment, but the Reserve Bank has been trying to get this for a long time because they want to see stronger wages growth. Now, when wages are only going up 2% per annum, in fact, in 2020, parts of last year, they were going up by less than 2% per annum. People don't feel very, very happy when you're getting such a low wage rise. And in fact, many Australians weren't getting a wage rise at all. So, yes, we do want to see stronger wages growth. And, of course, the forces that are helping to drive higher inflation, that is strong labour markets particularly, will start to push up wages growth. So hopefully we will start to see that come through. But by the same token, Joe Biden doesn't want to push that line too far, because the risk is that you end up with this wage price spiral. So you can have too much of a good thing here. We want a bit more in wages growth, but we don't want that to cause an ever-going surge in inflation like we saw back in the 70s.
Yeah, and the US at the moment seeing that inflation up at 30, 40-year highs, which is...
They certainly are. And we're nowhere near as bad as that. I mean, if you think things are bad in Australia, 3.5% inflation, that is a high number, but in the US it's 7%.
Yep.
So things could be a lot worse.
Yep. Shane, hey, great to have you with us and for explaining that for us, as always, done in a way that we can easily digest. Thanks, Shane. Talk to you soon.
Thanks, Pete. Take care.